Welcome to today's episode of Deep-Dive Café. I am Avery, and I'm here with Paige. Stick around, we'll be back shortly. All right, strap in everyone, because today we're diving deep into a topic that's, well, a little bit scary, honestly. We're talking about too big to fail.
Yeah, those financial institutions, mostly banks we're talking about, that are so huge, so deeply woven into the global economy, that if one were to actually fail...
It would be a disaster, like dominoes falling, right?
Yeah.
One goes down and it takes a whole bunch of others with it.
That's a pretty good way to put it. Not just a catchy phrase, though, is it? This concept of too good to fail. It's a real worry. I mean, we're talking trillions of dollars in assets.
Yeah, and from the research I've been looking at, it seems like governments are kind of stuck. They can't afford to let these institutions just collapse, but
by bailing them out, it creates this whole other problem, right? Moral hazard.
Exactly. If a bank knows it'll get rescued, they're probably more likely to take bigger risks.
Because the downside is less scary. Someone's there to catch them if they fall. So yeah, riskier bets, less responsible behavior, potentially.
And it's not like things are getting less concentrated either. This research shows the banking sector is actually becoming more concentrated. Fewer banks, but they're even bigger.
Adding fuel to the fire, really? More assets under the control of fewer players. Think about what that does to the interconnectedness of it all.
One giant tangled web. And speaking of tangled, this research gets into some really interesting ways of quantifying the subsidy these banks get just from being too big to fail.
Yeah, the benefits they get just from being perceived as unkillable, essentially. It's mind-blowing. Cheaper credit, better terms, all sorts of advantages smaller institutions could only dream of.
Lower interest rates, different treatment by credit rating agencies, even the way credit default swaps are priced, it's all tied in.
A financial edge just from their size and the implicit guarantee that they'll be bailed out if things go wrong.
But here's the thing. The research says even attempts to reduce this subsidy haven't really worked. Why is that?
It's tough because even if you make some progress reducing that perceived risk, the core issue remains. The bailout safety net is still there. A Band-Aid solution when you really need surgery.
So that brings up a fundamental question this research tries to tackle. Is a system with a handful of giant institutions inherently more stable than one with lots of smaller banks?
It's a question that sparks a lot of debate. There's argument to be made that a few massive, well-managed institutions are easier for regulators to keep an eye on.
I can see the logic there,
But there's a trade-off, right? Even if that's true and it's debatable, it likely comes at a cost.
Yeah, to the customers, to the overall dynamism of the economy, I imagine.
Right. Less competition, less innovation, potentially fewer choices for consumers. Do you really want to live in a world where a handful of megabanks control everything?
Definitely gives you pause. So if just chopping up these institutions isn't the ideal answer, what does this research suggest we do about this too big to fail problem?
Well, there's no silver bullet, that's for sure. The solutions offered are more about approaching the issue from different angles.
Layering the defenses, maybe? Okay, so where do we even start with something this complex?
One of the big focuses is on capital requirements, making sure banks have enough of their own money on the line.
Skin in the game, right? So if things go south, it's their money that's at risk first.
And the research gets pretty bold here. They're suggesting increasing those requirements until those implicit subsidies we talked about disappear, level the playing field entirely.
Make them stand on their own 2 feet. That's a pretty strong stance.
It is. The idea is to eliminate that moral hazard completely, but it's not the only piece of the puzzle. Transparency is also a huge part of it.
Ah, right, transparency. We touched on that briefly earlier. So what does that look like in practice? More sunlight on their operations.
Exactly. Making sure their financial dealings, their risk exposures, their overall health, it's all visible to regulators, to investors, to the public, shining a light on it all.
Because if everyone can see the risks they're taking,
it acts as a natural check, a deterrent. Plus, it allows regulators to spot potential problems earlier, before things get out of control.
Okay, so increasing capital requirements, increasing transparency, those seem to be two of the key pillars in addressing this. But I get the feeling it's not that simple, is it?
You're right. There's a lot more nuance to it. We need to look at how effective these solutions really are and what kind of challenges might come up when you try to put them into practice.
All right then, sounds like we've got a lot more ground to cover. Welcome back, everyone. So we've talked about what makes a bank too big to fail. the potential risks involved, but it's not just a theoretical thing, right?
Right, it's not just a concept.
Yeah.
We've seen real-world examples, unfortunately, of these institutions stumbling, and when they stumble, the whole world feels it.
Exactly. And I'm sure a lot of our listeners remember the 2008 financial crisis when it felt like, well, like everything was about to collapse.
Oh, absolutely. 2008, that's a prime example of what can go wrong when these massive interconnected institutions take on too much risk.
And the research specifically mentions the collapse of Lehman Brothers, Bear Stearns, AIG. Those are some key moments, weren't they?
Absolutely. Key moments in that whole unraveling. Especially Lehman Brothers. I think that's become almost a textbook case of too big to fail gone wrong.
Yeah, Lehman Brothers. That name really sticks with you. What was it about them specifically that led to their downfall?
Well, they were massively interconnected, highly leveraged, and then when the crisis hit, they lacked the liquidity to weather the storm. A perfect storm, really.
So too much debt, basically.
A lot of debt, yeah, tied to the subprime mortgage market. And when that market went belly up,
They were left holding a lot of bad loans. I remember that, all those mortgages going bad.
and they'd borrowed so heavily to finance those investments, they didn't have enough capital to absorb the losses. So, liquidity crisis. They couldn't get their hands on the cash they needed quickly enough.
It's like a classic bank run, except on a massive scale. Everyone wants their money back at the same time, and there's just not enough to go around.
That's a great way to think about it. And that fear, that was the really scary part. It spread like wildfire through the markets. Nobody knew who would be next. Lending basically froze.
It really felt like the whole system was seizing up. So the government stepped in, bailed out a few other big institutions, like AIG, right, to try and stop a complete meltdown.
Yeah, but they let Lehman fail. That was a big decision, a controversial one.
Why save AIG and not Lehman? It seemed like they were both in pretty dire straits.
There's been a lot of debate about that, but I think the consensus is that AIG was just too interconnected. It was an insurance giant. Its tentacles reached into so many parts of the financial system. Letting them collapse would have been catastrophic, even more so than Lehman.
So they were seen as even more systemically important, like too interconnected to fail even though they were failing.
Yeah, essentially. But it really highlights the problem with too big to fail, this catch-22. Let them collapse and risk a total meltdown, or bail them out and risk encouraging even more risky behavior in the future.
A tough spot to be in, for sure. So what did we learn from 2008? How do we prevent another crisis like that, another too big to fail situation?
Well, the source material argues that we need a multi-pronged approach. Tighter regulations are a big part of it, stricter oversight. And then there's transparency, which we talked about earlier.
Right, transparency, shining a light on the inner workings of these institutions.
Exactly. The more we can see what's happening inside these banks, the better equipped we are to manage the risks.
It makes sense. More information helps with better decision-making, both for the regulators and for the institutions themselves.
It also makes it harder to hide risky behavior or to sweep potential problems under the rug. Sunlight is the best disinfectant, as they say.
Okay, but how do you actually implement that kind of transparency, especially on a global scale? I mean, it sounds incredibly complicated.
It's a huge undertaking, no doubt. But the source material suggests looking at technology as a solution, blockchain, for instance, and AI-powered risk analysis tools, even open-source data platforms.
Using technology to create a more open and accessible financial system. It's like what we've seen in other industries, using these new tools to revolutionize how things are done.
Exactly. It's not just about tweaking existing regulations. It's about fundamentally changing how we approach systemic risk, building a more resilient, more transparent system from the ground up.
Okay, so we've covered a lot here, talked about the dangers of too big to fail, looked at some real-world examples. But it feels like there's still more to discuss.
Oh, definitely. We need to look at the potential solutions in more detail, see how effective they might be, what kind of challenges they might face.
All right, well, let's do that then. Welcome back, everyone, to our deep dive on Too Big to Fail. We've talked about the risks, dissected some infamous collapses, and now it's time to explore solutions. How do we prevent history from repeating itself?
Well, the research doesn't give us one easy answer. It's not that simple, unfortunately, but it does highlight a few really promising approaches.
We talked earlier about breaking up the banks, making them smaller, but the research also points out some potential problems with that approach, doesn't it?
Yeah, there are definitely some downsides to consider. Like, you could stifle innovation, make it harder for them to compete globally.
If they're too small to finance those big projects or to go head-to-head with those international giants.
Right. It's a tough balance to strike, and that's one of the reasons why the research really emphasizes increasing capital requirements as a primary solution.
Making sure those banks have more of their own money at stake, more skin in the game, as we said before. But how much is enough? The research suggests pushing those requirements up until those implicit subsidies, those benefits they get just from being too big to fail, they disappear. That seems like a pretty drastic measure.
It might seem drastic, but think about it this way. If a bank knows it's got a safety net, if they know the government will step in to rescue them, well, they're probably more likely to take risks they wouldn't even consider otherwise.
Because the downside isn't as scary. They know someone's got their back.
Exactly. So by removing that safety net, we're basically encouraging, or maybe forcing is a better word, more responsible behavior. It's like, teaching someone to swim by throwing them in the deep end. Sink or swim.
Okay, I can see the logic there. Tough love for the banking sector. But I'm guessing the banks themselves wouldn't be too thrilled about this.
Oh, there would definitely be pushback. No one likes playing with fewer chips, right? Especially when the stakes are this high.
But that's where transparency comes in, right? That's the other big piece of the puzzle.
Absolutely. It's not just about changing the rules of the game. It's about making sure everyone knows what those rules are and how they're being followed.
So, more visibility. Letting everyone see what's happening inside these institutions.
Exactly. Imagine if you could see in real time the risks these banks were taking. It'd be like having a window into their decision making.
That'd make it a lot harder to hide risky bets or, sweep problems under the rug. But how do you actually implement something like that? It sounds incredibly difficult, especially when you're talking about a global system.
Oh, it's a huge challenge, a logistical nightmare, potentially. But the research suggests that technology might be the answer. Things like blockchain, for example. AI-powered risk analysis tools.
So using the same tools that are driving innovation in other industries to revolutionize how we manage and regulate finance.
That's the idea. We're not just talking about tinkering around the edges here. We're talking about fundamentally changing the way we think about systemic risk, building a more resilient system, a more transparent system.
This has been a fascinating discussion. It's clear that this too big to fail problem is complex, to say the least, but what's the key takeaway for our listeners? What can they do with this information?
I think the most important takeaway is that too big to fail isn't just some abstract concept, it's a real threat. It can have a real impact on all of us, on our financial well-being. So as informed citizens, we need to demand better, demand more.
Demand more transparency, more accountability from these institutions.
Exactly. And we need to hold our policymakers accountable for putting meaningful reforms in place.
So it's about staying informed, engaging in the conversation, and making our voices heard.
It is. We can't just sit back and hope for the best. We need to be active participants in shaping the future of finance.
Well said. And that brings us to the end of our deep dive on Too Big to Fail. We hope you've learned something new, something to think about, and maybe even something to act on.
Because remember, the financial world never stands still. It keeps evolving, and this issue, this too big to fail problem, it's going to keep demanding our attention. So stay curious, stay informed, and most importantly, keep asking those tough questions.
And until next time, it's been Avery
and Paige.
Keep diving deep.